Good morning, everyone. My name is Marty Cheetah. I'm a principal in the Denver office of Moss Adams. We are a full service public accounting firm that has offered audit, tax, and consulting services for the oil and gas industry for over 40 years. I want to thank Intercom team for another, albeit different, successful conference. I have the pleasure of introducing our next presenter, Mr. Tom Jordan, President and CEO and Chairman of the Board of Cimarex. Mr. Jordan has been with Cimarex since the formation in 2002. He is a graduate of the Colorado School of Mines and also serves as chairman of the boards of trustees for the Colorado School of Mines. Please welcome me in telling more about Cimarex Energy, Mr. Tom Jordan.
Well, thank you, Marty. I want to also congratulate Intercom on 25 years. That's quite an achievement. This conference has grown over the years, and we're just delighted to be back as an original participant. I understand that we're in a fairly elite group of 8 companies that were there at the very beginning, so we're happy to be here today. I'm going to share my screen, so if you'll just give me a second to do this, and then I'll go into presentation mode. And can I get a thumbs up if that's visible there? Okay, great. So again, thanks for the opportunity. And I am live, so you'll have the opportunity for Q&A, and I really do welcome your questions. I would hope that this would be more conversational. The Zoom platform, I think we're all getting comfortable with. But in introducing Cimarex, first, standard forward-looking statement, I'm going to be giving a lot of comments about the future and some of it's speculation, but you all know the drill there, and proceed accordingly. Well, at Cimarex, we've really laid out our core strategy along 5 pillars. And those pillars are planning, doing a much better job of planning for our future, looking back on our business, understanding what calibrations we need on cost, on well performance, on LOE, and so on, and really making better, more detailed projections for the future. And we've made tremendous progress there. We're also focused on cost control, as so many of our peers are. We've made tremendous progress there, and I'll be telling you about that. Exploration is one that probably needs to be renamed. What we really mean by that is a constant asset rationalization. We want to make sure we have the most profitable assets to generate free cash flow going forward. That includes exploring for new assets and making sure that we have a low entry cost to the extent that we can acquire more productive assets. But it also means rationalizing our existing portfolio and looking to divest things that no longer are core and have a place in our focus list. We're also highly focused on digital innovation. We're building a whole series of tools to make our business more effective. I really hats off to our organization on that. We're getting information in the hands of decision makers in real time with absolute accurate information. As I talk about Cimarex, I'm very proud of our organization. I also feel like with our incredibly talented technical staff, decision making is our core DNA. And if we can get great information in real time in the hands of our decision makers, I gain increasing confidence in our future. And that's what that digital innovation is all about. And then environmental is really a focus of ours. I'll be talking about ES and G. That's a part of our culture. We're very serious about it, and that will become apparent to you as I talk about our year to date. Well, year to date, our operational highlights, and we talked about this on our call, we're having a year of good cash flow generation. We're having a year of good discipline. We laid down our activities. We went to 1 rig in the spring, and that was, I think, prudent for the time. We did a complete scrub of our operating costs and made very prudent shut-in decisions where appropriate to make sure that we maximized our cash flow. And when prices really cratered in the month of April, is the nadir on that, we absolutely wanted to make sure that we could identify fixed and variable operating costs and make sure that we were not operating any property at a variable loss. We brought 12 wells online in the second quarter at a really nice cost structure, and I'll be talking about that as well. Our all-in costs in the Permian are currently at $800 to $900 per foot. That's a mix of lateral lengths, and I think our average lateral length is about 9,000 feet. That also is a cost number that includes everything associated with that well: drilling, completion, facilities, and flowback costs. So real costs, we're sitting about $900 per foot, and there's a fair spread there, as I'll talk about in a minute. We also have a lot of ESG metrics, corporate goals this year, two in particular. One is to bring our flaring intensity down, and two is to reduce our methane intensity. As you can see here on this slide, we're making great progress on flaring intensity. We had a total company goal and a Permian goal. And we did both because we don't do much flaring outside the Permian. So we thought it would be disingenuous to only talk about a total company goal. And so we really focus on that Permian flaring intensity. We flared just a hair under 2% last year. Our goal this year was 1.44 with a stretch of 0.96. And year to date, we're at 1.08%. And we're pretty dedicated to hit that stretch goal. Our costs are down sequentially. Our cash costs per barrel of oil are really trending nicely. We think most of that's going to be sustainable, assuming that the overall climate is sustainable. The only caveat that I would offer is, we have deferred some workovers, so that'll probably add a little more. But we're seeing a real sea change in our cost structure across the board, not only capital, but also operating costs. It's been a crazy year, and you've heard that from every one of my peers. You'll hear it from me. We went to remote work March 17th, and really had a serious focus on employee health and safety. And hats off to our workforce. We haven't had a single case of COVID transmission that we can trace back to the workplace. We all mask up whenever two or more of us are together. Our field has had a great safety record, and really hats off to the field that's been hard at work every single day. We're in the process of staging our workforce back. We now have our workforce back, except for those people that have special needs, either special health risks or special needs, otherwise family needs. We're on an A-B work schedule, so every other week we have a workforce back, such that no more than half of our workforce is in the office at any single point in time. But I'll tell you, we're glad to be back. We're taking advantage of the opportunity to have face-to-face contact. And although Zoom was very effective, it's not wholly effective. Cimarex is an organization that manages by eye contact, and we're really glad to be back. Our response to this climate, both COVID, but also the oil and gas downturn, was to focus on free cash flow. As I said, reduce our capital investments, curtail our production, and our organization responded lightning fast on that. We brought our production back and looking at capturing lessons and cost efficiencies on a go-forward basis. As we resume activity in the third quarter, this slide kind of shows the pace that we're resuming. By early September, we'll have 4 rigs running, all of them in the Permian Basin, and 2 completion crews. And those completion crews will be hard at work, reducing some of the completion backlog we've developed. We'll have at year end a number of wells, 46 wells that are yet to be completed. And so that'll be a nice head start into 2021 as we have some uncompleted wells. Our capital investments to date, I don't need to read the slide to you, but we're right on track with what we announced early in the year. We expect to end the year with total capital of somewhere, give or take, $600 million. And that's a healthy spending level. And as we look ahead into 21, we feel pretty confident that we're going to see a world of greater capital efficiency. In 2020, our spending was, of course, dominated by the Delaware. And as you can see here in the slide, predominantly it was Wolfcamp, but it was pretty good mix county by county. We had activity in all 4 of our major operating counties. You can see our average well length, as I said earlier, across the basin. We're at about 9,000 foot of average horizontal well length. really, that's a great place to be. Our assets allow for those long horizontal wells, and that not only do we get a great return on capital, but that's a really efficient way to do it. So we're really pleased with the complexion of our assets, the quality of our program, and as we look ahead to 2021, we're feeling like we've taken the opportunity in this downturn to position ourselves very effectively for 21. Our development projects in 2020 and 2021 are shown on this slide, and I don't need to read the slide to you, but you can see it's spread over the basin. We have a number of development projects underway of varying size, learning the lessons that we learned in 2019, 2020. I said in our quarterly call that we are selectively relaxing our well spacing in the upper Wolfcamp. We've learned some lessons on this reservoir. We've learned some lessons on well-to-well interference, and we think it's prudent to relax our spacing. That's one of the elements as we look into 2021 that will give us greater capital efficiency. We don't just expect, we know that we will see better per well performance in 2021. I want to reiterate something I said in our call. We develop a lot of reservoirs. Here in the Delaware Basin, we've got a Bone Spring sequence that we've got the Avalon and Leonard. We've got a whole section of Bone Spring sands and shales. And then we go into the Wolfcamp, and that's a number of different reservoirs themselves. When I say we're relaxing our spacing, that's particular to the upper Wolfcamp. It's not particular to necessarily any of the other reservoirs. It also doesn't apply to our Anadarko asset, which I will get to here in a minute. Federal permitting has been a real subject of interest to our entire sector, and we've tried to be pretty transparent on that. Between now and 2023, we think we'll have about 46 wells on our schedule, and this slide just illustrates where we are in permits. We have 32 permits approved that mostly are ready to go. Some of them will involve getting extensions. Federal permits are good for a 2-year time frame. So if you look out more than a year or two, you're certainly going to be looking at a landscape where you're going to need to extend those permits. So of those 32 we have in hand, about half of them will need extensions. And then we have 14 additional permits that are in progress and we expect to see shortly. So we feel very solid over the next few years as to where we are with federal permits. But we also want to be very transparent that there are risks associated with that. Although we've never had a federal permit extension denied, a different posture out of the federal government could lead to a different result, not only on permitting, but right-of-way, species protection, waters of the U.S. And so we're going into 2021 very optimistic. We've heard encouraging signs regardless of the outcome of the November election, but we're also building contingency plans. If we needed to, we could accelerate in New Mexico. In aggregate, although we only advertise these 46 permits, we really have 139 permits on hand ready to go. It's just that 46 of those are part of our current rig schedule over the next few years. So we're developing contingencies to accelerate in New Mexico if we chose to do that, but also contingencies to pivot to Texas. And we have great depth of inventory in Texas, really high quality assets. So regardless of this situation on federal acreage, although we are very optimistic, the only thing I want to leave you with is we've got lots of contingency plans and we have the assets and opportunity to support them. We're seeing really good cost improvements in our well completions. This shows 2020, 2018, 2019, 2020, our total costs per completed foot. And again, these are actual costs, everything included. So we include, as I said earlier, all drilling completion costs, all facility costs, and also flowback costs. And you can see go forward, these, what you see on the table to the left are our actual, which includes a lot of history of a higher vendor cost. And we've also made some innovations to get these costs down. Our go forward costs are shown on the right. These are actual AFEs for new wells, and these are costs that we're achieving today on a go-forward basis. And you can see they range from a low of $750 per foot in Culberson County to a high of $1,000 per foot in Lee County. And of course, that's a function of lateral length. It's a function of facility size. It's a function of facility size. It's a function of depth, pressure. A lot of things drive that average. But overall, we're guiding for our Permian program in aggregate to come in between $800 and $900 a foot on a go-forward basis. We've talked a lot about the quality of our assets, and I think it surprised many to realize that that the counties we operate in and Cimarex's results generate some of the oiliest wells in the basin. And the only point of this slide I'd draw your eye to is on the left, the Culberson County slide, where we show 6-month cumulative production, 12-month cumulative production, 18 and 24-month cumulative production. When we compare the average oil cum against the rest of the Delaware Basin, I think many people are surprised to learn that those Culberson County 2-mile wells of ours stand out as some of the oiliest wells in the basin. They're also some of the lowest operating costs in the basin. This slide is really meant to highlight our operating costs in aggregate looking at Culberson County. We've done a lot of things to bring our operating costs down, but as you can see on the slide, our actual operating costs in Culberson County are about $1.85 per barrel of oil equivalent. And there are a lot of elements as to why those operating costs are so low. First and foremost, it's the rock. These are overpressured reservoirs, the ability to drill a 2-mile well with gas in the reservoir. This is some form of condensate that we're producing in Culberson County. We get tremendous lift out of that wellbore. We don't have to go on artificial lift until about 18 months into the well's life. So that gives us a real head start on low cost production. We also own and operate our own gas gathering system, our own gas gathering, our compression. We own and operate our own saltwater disposal system in Culberson County. As you know, this is a joint development agreement between Cimarex and Chevron, and we jointly own those midstream assets with Chevron. It provides some of the lowest operating costs in the basin, really offers tremendous opportunity to us. One of the opportunities is the opportunity to recycle our produced water. The picture you have in front of you is a riser. We have many of these risers throughout our field where the pipes that carry produced water come out of the ground in the riser. We can tap into that riser and divert the produced water to a nearby frac crew and deliver water on demand to a frac crew without ever having to store produced water in a surface pit. Not only is it a tremendously elegant solution, but it's also an environmentally friendly solution because it reduces the risk of a spill with surface storage of produced water. So we're able to generate real-time produced water to our frac crews. And you can see in the graph in the lower middle of this slide, the degree of recycling we're doing. For the water we use in our completion operations in Culberson County, in 2019, 94% of it was produced water. And in the first half of 2020, 100% of our frac water was produced water. So hats off to our operating group. This was a tremendously elegant solution, and it was organically driven by some really, really good, talented engineers. Well, I said I'd return to the Midcontinent. In my second quarter call, I said, don't be surprised if we spend a little more capital in the Midcontinent next year. We're seeing some really, really attractive opportunities in our Midcontinent assets. As I've said in the past, we kind of sent our team to the drawing board and said, compete for capital with that Delaware Basin project. And along the eastern margin of our assets, we have some 10,000 foot horizontal well opportunities that generate truly outstanding returns. Not only are they enhanced by lower costs, but we drilled some wells in the latter part of 2018, testing some new completions. And as we watch the production of those wells, they are just stellar and generate returns that rise to the very top of our portfolio and compete with the Delaware Basin. So we'll be returning to the Anadarko Basin in 2021. Again, probably not more than 10 or 15% of our capital, but it's really, really a great part of our portfolio, and we're thrilled to have it. So our long-term strategy, for those of you that have followed us in the 25 years since Intercom 1, we've been fairly consistent. We're capital discipline organization. We want to optimize our assets. We focus on financial strength, and one of our long-term plans we've talked about is retiring some debt with free cash that we're going to generate. And then we're very committed, as we always have been, of return on capital. When we invest, we want every one of our invested dollars to generate good returns, but also return of capital in the form of a growing dividend. Our priorities go forward, first and foremost, employee health and safety, but we execute. You know, Cimarex is a company that wants to be known and measured by our results. It's great to talk about what we intend to do. It's better to talk about what we've actually done, and that's the conversation we want to have with you. We're looking forward to a focus on free cash flow generation, and as I've already said, growing our dividend over time. As we look ahead into 2021, we've talked about a $35 base planning file, and we're very, very confident that at $35 oil, we can cover our dividend, generate free cash, and and this is not, we're not announcing capital for 2021, but if we were to have capital in 2021 that was roughly equal to 2020, we can accomplish all these things and generate single-digit oil growth. So as we look ahead to 21 to 2024, we see a future we're highly confident in, and we intend to bank cash. Our next debt maturity is 2024, and we'd like to call those notes with cash on hand. That's kind of our long-term goal, in addition to growing our dividend. Well, we've always had a strong balance sheet. We don't have any near-term maturities. We're currently hanging firm to our investment grade rating and have good liquidity. But hopefully, for those of you that know us well, that doesn't surprise you that we're financially strong. That's part of our DNA, managing a business in a cyclic environment. And then I'll wrap up just summarizing. You know, at Cimarex, we've got a proven track record. We have a great portfolio of assets. You know, I love talking about our culture, but culture is really talking about results. Although I firmly believe that culture is a competitive advantage in our business, it's only competitive advantage to the extent that it generates consistent results over time. And so we really do like to focus the conversation on results. And then we have a strong financial position that allows us the luxury to focus on getting better at the business and keep the wolves at bay during downturns in our commodity business. So with that, that's Cimarex. I really thanks for the opportunity to talk about Cimarex and look forward to taking your questions.
Tom, thank you very much. I appreciate it. We've got a number of questions here from a number of listeners here, so I'll just kind of dive right in. First question here, seems like Cimarex is planning to turn in line quite a few more wells in 2021 versus 2020 to deliver flat volumes. Is that generally accurate in your development plan?
Well, we will complete more wells. I don't have the specific numbers in front of me, but you know, one of the things that, you know, we'll have a pretty good DUC inventory at the beginning of 2021. Our 2021 capital productivity is only marginally impacted by that DUC drawdown. We're having a certain DUC inventory is kind of regular part of the business. So if you look at our current projection, again, we haven't outlined 2021 yet, but obviously we have a working model. If you look at that model, our beginning of year DUCs and our end of year DUCs in 2021, it doesn't show a huge drawdown of that. You know, in a business where you're drilling development wells, a certain background DUC inventory is probably just part of the business.
And so staying on that theme, obviously you haven't put out the guidance, but folks are focused on that 2021 area. Is 2021 more capital efficient for Cimarex due to the wider spacing, which may have hampered some of 2020 a bit?
Well, it is. You know, as we've said on the call, it's really three attributes. The first and the lowest of the three is that we will marginally bring down a few ducts during the year. The second is increased capital efficiency out of our wells. We're just, because we're widening the spacing, if we not only expect, we absolutely know we're going to get better per well performance. And then the third element is reduced costs. As we look at costs in Culberson County, for example, a go forward cost that is $750 a foot. And we do have some projects that we've recently brought online that are less than $700 a foot. And that just allows you to do so much more with capital you deploy. So those three elements are really driving our capital efficiency as we look into 21.
And so here's one question focused a little bit more on pricing, specifically realized natural gas prices. Can you comment on the degree in which infrastructure or hedging program going forward may enable an increased price as you think about your realized prices on natural gas?
Well, using hedging as a lead into that is probably not my focus. If you get a lot out of your hedge book, that means prices are low, and so we typically try to hedge about half our volumes go forward. And I don't know what I hope for. I mean, I think I've heard it described that commodity pricing, you've got an asymmetric risk. You'd probably rather give up a little of the upside than have to live with the full weight of the downside. And so that's why we hedge. It's just kind of a insurance. It's a shock absorber in our cash flow, but we always leave half or more available to be market takers. As we look ahead into 2021, we're looking at actual receipt prices in Waha that are $2 or give or take. And that sounds delightfully good compared to where we've been in 2020. So, I know there's a fair amount of bullishness out there on natural gas. We produce a lot of natural gas, although it's been a smaller part of our revenue and cash flow in the last couple of years. I really look forward to a world where it's a bigger part of that pie, because that means that it's just a healthier net back price. But that's what it looks like we're going to see.
So I've got a question here from Greg Barnett, obviously the founder. You mentioned that you guys were part of one, and so I'd be remiss if I didn't take his question. He says, "Time flies when you're having fun, Tom." He asks, now that you have a great production history in the Permian, are there zones that would be candidates for a refrac program or wells in areas that could get back to near original pressure and production levels?
We've experimented with refracs. We had a pretty good refrac program. I think it was late 18, and we were a bit disappointed in it, quite frankly. Refracs are great selectively, but they involve a lot of mechanical risk. And then the other thing I'll say, a lot of these Permian reservoirs have a lot of native permeability. I'll contrast that with the Woodford Shale in the Midcontinent, where in the Woodford Shale, that rock almost, for all intents and purposes, has zero permeability, and your producibility is completely governed by the fracture network that you generate. Whereas in the Delaware Basin, whether you're talking about the Upper Wolfcamp or that Bone Spring sequence, one of the learnings we've had in the last couple of years is just a deeper appreciation that you're draining a rock well beyond your fracture network itself. And so that itself is probably a negative in the efficacy of a refrac program, because you've just drained that rock above and beyond your fracture network. Refracs also have mechanical risk, and they're a real opportunity for massive overexpenditure on a project, quite frankly. I will say this, although we're interested in refracs or even re-drills in the Midcontinent, in the Delaware Basin, we're finding selective effectiveness with recharge. That if we're drilling next to a parent well, we can recharge that parent well. And we've done some experiments on that, and we're kind of encouraged by what we've learned. But Greg, I don't think you're going to see a big refrac program in the Delaware Basin here in the next couple of years.
So I got a couple questions here on the same line, so I'll kind of lump them all together here. Uh, any thoughts on the M&A opportunity given where we are today? And then tied into that, any look back thoughts on the Resolute transaction as you sit where you are today?
Yeah. Well, I know there's a lot of talk about M&A, and it certainly makes sense on a spreadsheet. And you know, we get asked about this a lot. Everybody gets asked about this a lot. So I would say this, you know, at Cimarex, we're certainly not tone deaf to M&A. We understand fully the benefits of consolidation, lowering your combined cost structure and taking efficiencies there. There's economies of scale across our business that are beneficial to being bigger. But then you get to the reality. Merger of equals is often a term thrown around. And you know, the problem there is you've got two cultures, two executive teams, and you know, the way these deals usually play out, and there have been lots of phone calls exchanged in our sector. I think that you've probably heard that from multiple peers of mine. And the first call is very friendly, and you know, one company is pitching to the other, hey, we ought to really combine, and it makes sense, and yada yada yada. And the first call congenial, and it ends with, well, yeah, let me think about it, let me talk to my board, and I'll call you back. And the follow-up call goes like this: CEO A says, boy, we really like the idea, but our board's absolutely insistent that our management team has to be the surviving management team. And CEO B says, wow, that's interesting, because our board said the same thing about our management team. And so, you know, you either figure a way through that, which is very difficult, or you lock both teams in the room and play around the Russian roulette and let one survive. You know, you also have the board consideration on this. And I really want to throw this out there, because I think sometimes it's not well understood. You know, boards get to know a management team, they get to know assets, they get to know operating style, and boards get to know cultures. And it's a difficult ask at zero or low premium. And that's kind of what we're talking about in our sector right now. I think we all know that high premium deals have fallen like a big thud on the marketplace. Markets are fairly efficient. We're all priced with a lot of information. And so generally a merger of equal almost implicitly is discussed as a low or no premium deal. Well, boards are very, very reluctant to hand the keys over to a management team they do not know at low or no premium. And so, yes, consolidation is really good in principle. It's just hard in practice. But we're, you know, at Cimarex, I'll say this: we are not an entrenched management team. We work for our owners, and I mean that in the fullness of every word that's in that. We work for our owners. And so for the right deal for our owners, we would look at consolidation. Obviously, I have a lot of confidence in our management team and our organization. I think Cimarex would be a great consolidator, but we work for our owners on all sides of that coin. You asked about the Resolute transaction. You know, we love Reeves County. They're great assets. We love to have them. We also priced that deal at a 60, you know, oil was mid 60s when we did that deal. And we also had projected a much higher activity level in 2020 and even latter half of 19 than we actually prosecuted. And that was because of the downturn in commodity pricing. So I'm going to be totally forthcoming. You asked, how's it look on a look back? Well, any deal done at a $65 price where you were projecting a high level of activity and then price halved and you had no activity isn't going to look very good on a look back. But when we did the deal, we were looking ahead a decade or more, and that's still our perspective. If we had to just snapshot it right now, and you didn't give me any future, it's going to be much less than it looked when we did the deal. But I'll say this: we love the assets, and they're going to be a really strong part of our portfolio go forward.
Oh, absolutely. And anyone who could forecast we would be where we are today had a better crystal ball than myself, for sure. keeping you spoke a lot about culture, and I've got, you know, a couple comments on ESG, and you gave a nice dialogue on that. But you know, maybe one of the S things of that is, how is Cimarex retaining its professional staff and attracting new talent, particularly in this type of environment?
Well, that's, you know, I'm really, whoever asked that question, thank you for that, because that's something we're all, our executive team is very passionate about. We have a lot of young people. If you look at the complexion of our company, we've continued to refresh, and we've recently had the opportunity to look at that, the experience level of our company over time. And it looks today like it did a number of years ago, and that's because we've continued to refresh with young talent. And there's probably no better example of that than this year. We had a very short conversation, because we were all working remote, on whether we would go ahead with our college intern program. And we decided very, very quickly, it was a difficult decision, but didn't take us very long, that we had made commitments to these students. We didn't know what other opportunities they might have turned down to commit to a job with Cimarex. And so our college graduates and our interns, we brought them on fully, and it was great. About 10 days ago, we had an intern presentation prior to these kids going back to school. It's my favorite day of the year, and we will continue at Cimarex to bring in new talent and refresh. You ask how we keep people. One is, we haven't had global reduction in force at Cimarex. Fortunately, we haven't had to do that, because we've always kept our organization fairly lean. But even through the better employment periods, our turnover was relatively low. And I ascribe that to an organization where people can make a difference. We give people challenging work and don't silo them. We have incentive systems where people have a line of sight between what they contribute and how they're rewarded. We also have a very open culture where people have exposure broadly if they have great ideas and they do great work. Then the last thing I'll say, and the reason I love coming to work at Cimarex, is it's a company where an individual can make a difference. We're not so hung up on procedure or hierarchy or habit, that a person at Cimarex can start today and fundamentally change the direction of this company through creativity and the ability to communicate good ideas. And that's an exciting thing for anybody to be able to say about their employer. And I think we've got a company full of people that feel that way. So, as you can tell, I'm not really objective on this subject, but I'm pretty proud of our workforce.
Well, Tom, I think that's a great place to leave it. We've got a number of other questions, and I'll encourage folks to reach out to your IR team and continue the dialogue. I know we've got some one-on-ones potentially. But I do want to say thank you, Tom, for being here and being a great supporter of what we're doing over this time. And I appreciated the dialogue.
Well, thank you for having us. Again, congratulations on 25 years. And whether I'll be the presenter or not, I really look forward to Cimarex presenting at Intercom 50. So,
we'll hold you guys to that. Thank you.
Thank you so much.
All right.